Well, welcome to my tutorial. I am really sorry that I couldn't make the tutorial by using the computer in a regular way. That's because the sound is not working properly. But at least I can send a video link so you all guys can have access to it and explain what I've done. A little summary of chapter 2. As you can see, I'm gonna take it closer. This is going to allow me to make things easier as I can zoom in properly. You can see there are two companies here, Tesla and Samsung. And I've taken a script capture in Yahoo Finances from each of these companies just to compare the debt to assets ratio. As you can see here, we have the assets, the total assets and total liabilities over there for 4 years, 2021, 2022 until 2024, and the same for Samsung. As you can see, maybe you can see it here better. Let's see if I can do it a better job here so you can see better the numbers. Okay, so what I've done is exactly what I've mentioned before. I've move the screen. I've made the formula to calculate debt to assets. And as you can see, both companies have increased their level of confidence in terms of being able, if we were bankers, of giving them loans. The debt to assets ratio of Tesla is 39%, which means that of the total assets, 39% are supported by debt. And in the case of Samsung, 21%, almost 22%. It's interesting for me to see that these companies are not searching to have a lot more debt compared to their assets. The debts are being reduced. I think that's good, but sometimes some companies, I guess, when they begin, they ask for many loans and getting significant debts to make great investments that will provide sufficient returns to pay them back. Okay. Okay, so but this is not the only thing is that we've learned. I think I have here a little summary in the balance sheet formula, which let's look it up, which is similar to this. The assets equals liabilities plus common stock minus dividends plus revenues minus expenses. As we all know, all of these accounts separately have accounts that follow a T account pattern of dividends and credits. So I got this image from the book. So we can see here all the accounts that there are of assets, cash, accounts receivables, notes receivables, inventory, prepaid accounts, supplies, investment in land, equipment, buildings, land, patents. And then you have here liabilities, which are accounts payable, short-term notes payable, unearned revenue, accrued liabilities, long-term notes payable. And now you have equity accounts, common stock, dividends, revenues, expenses. Well, all of these accounts follow what you call a T account format because of the shape it forms with debits and credits. So each of these formulas follows a specific pattern in terms of debiting, of crediting, depending on what part of the formula they are. So for example, I have some examples here. If we get a $1,000 transfer cash, we are going to debit the assets account, which means we're going to increase it. I'm sorry. And if we purchase land, we are also going to, well, in that case, I think I made a mistake here. We credit cash. Fix that. We credit the cash account, right? So if we go here, the cash account of the assets would have $1,000 debit of the money received, and then $1,000 credit. Then if we ask for a loan, then we credit the liabilities account. We're increasing it, right? So we credit. If we pay dividends, we debit the dividends account. Because when we're paying dividends, we are increasing the dividends amount. If we were to receive dividends, then we would receive we would credit this account. Okay. Now, issuing common stock. If we increase the common stock, we are crediting that account. And a revenue of $1,000, we are crediting the revenue account, as you can see there. Okay, we have $1,000 expenses, we credit this account. Sorry, we debit this account. Okay, so so how do we, what's the process of doing all this? First, we have the source documents. Then all of this goes to the accounts, which are here, these accounts, right? That follow the T pattern, that does not have to end up in zero, but although each account separately does not have to end up, I mean, when I mean zero, in equal terms, it does have to be equal, right? As a whole. And then we have here the chart of accounts, which is a list of all ledger accounts. So for what I've been able to understand, the accounts go to the general ledger, and then there's a list of these accounts in the ledger called chart of accounts, and all of these accounts go to the general journal. And then what I forgot to mention, after we do that, I didn't type it down, but we will be able to do the income statement, the retained earnings statement, the balance sheet, and also the way of doing the cash, the cash table, let's say. I've forgotten the name. So that's the best I could do given my circumstances.